Hello, everyone. My name is Robin Reese, and I'm the Executive Director for Commercial Observer. Thank you for attending today's webinar, Bridge Financing and Valuation Trends Amid a Changing Commercial Real Estate Landscape, presented by Arbor Realty Trust. We have put together a veteran panel of commercial real estate finance, valuation, and economic experts to discuss which asset classes are best suited for bridge financing, trends in appraisal approaches and valuations, and other best practices for pairing bridge loan terms with your long-term financing goals. Before we begin, I'd like to cover a few housekeeping items. At the bottom of your audience console are multiple application widgets, including a resources button where you can download today's slides or Arbor's white paper on bridge financing. You may also submit questions directly to each of our panelists or moderator by using the Q&A widget. With that said, I'd like to introduce our two panelists for today. Susan Kaminsky, Senior Managing Director at BBG Inc. Gianni Ottaviano, Senior Vice President and Director of Structured Finance Production at Arbor Realty Trust. I'll now turn it over to our moderator for today, Sam Chandan, Silverstein Chair at NYU SPS Schack Institute of Real Estate and founder of Chandan Economics. Sam?
Thanks very much, Robin, and good afternoon, everyone. Looking forward to joining you for today's webinar on bridge lending. If we take a quick look at the slide that describes the outline for today's call, we'll begin with some brief introductions. I'm going to turn it back to Gianni in just a moment to tell us a little bit about Arbor, and then Susan to tell us a little bit about BBG as well. I'll spend a couple of minutes talking about the state of the market and a little bit about what we see happening in the macro environment before we pass it on for a discussion of valuation trends, Arbor's bridge loan program overview, and then we'll take Q&A. And as Rob mentioned, at any time during today's call, use your Q&A box in the presentation manager to share your questions with us. But with that, let's kick it off. I'll turn it back to Gianni.
Thank you, Sam. So Arbor is a national direct lender providing capital for commercial real estate. Our asset classes are multifamily, office, residential, retail, industrial, as well as some senior and healthcare. We've been around for well over 20 years, long-standing bridge lender for various asset classes nationwide. We are also a leading Fannie Freddie lender. We also do FHA and CMBS. We're a top 10 Fannie Mae lender and have been for the past 10 years, as well as a top Freddie Mac small loan balance lender, which is loans between $1 million and $6 million. We've been the top lender for 2 years in a row. The program is actually 2 years old. We helped develop that program with Freddie Mac. We also service a portfolio of about $15 billion in loans. We are an S&P Select servicer. We originate well over $1 billion per quarter across the entire platform. The next slide just shows you just a couple of the asset classes and some of the things we do, multifamily, office, hospitality, retail, Fannie and Freddie. Important to note here, Arbor, with our $15 billion portfolio, we actually service all the deals that close through Arbor's origination platform. We service. So something that's a little bit different than other bridge lenders, we service all our own deals. The borrower is not dealing with any third-party servicer. It's basically a one-stop shop. We originate it, we process it, we close it, we service it, which is very beneficial for most borrowers. I'll hand it over to Susan now. I'll give you a quick rundown on who BBG is.
Yes. BBG is the second largest firm in the country that offers both valuation and environmental and property condition assessment. We also offer financial advisory services for financial reporting. We have, since this was written, we've actually opened 2 or 3 more offices. We're across the country. We have, licensed and MAI appraisers throughout all of our offices. We service all aspects of the industry, from equity to debt, and our technology is state-of-the-art, and we have an extensive client management system to give everybody personal attention. We've been around for quite a while. We've morphed over the years, but the core team has been together for probably over 15 years at this point. And we do all property types, obviously, all over the country, including Hawaii.
Great, thanks very much. This is Sam again. I'm founder of Chandan Economics. I'm nominally involved in the firm. For those of you who are in New York, my primary role is to head up the Schack Institute at NYU School of Professional Studies. Chandan Economics focuses on collecting loan data in the market, not CMBS or agency per se, which are generally readily available, but also life company loans, loans being made by banks. These are not easy data points to collect, but we do bring them together to support risk analysis around what we see happening at a macro level in the lending market, as well as a little bit about what we see happening with individual bank portfolios. With that, we're going to jump ahead to our first slide with information about what we see happening with transaction volumes. And I think what you can see over here is that while the market is certainly very strong as compared to where we were just a couple of years ago, well, more than a couple of years ago now, 2009, 2010, obviously the trough of the market for all of us. What the slide shows, once you abstract away from the seasonality, which is introducing some of the up and down that you've got here in the chart, is that the market has slowed somewhat. So, and that really is across the board: apartment, office, retail, I think, being impacted most significantly, but hospitality as well. Industrial, I think, is one of the sectors where we continue to see some strength, but overall, I think what we've seen is that there's been a relatively modest decline in activity and momentum in commercial real estate investment and lending activity. If you were to compare that to where we were in 2007, 2008, you could see that we hit a peak in the market and then experienced, as most of us will remember, a very steep and dramatic decline. Whereas this time around, at least thus far, that coming off of the peak looks to be sort of a much more modest and manageable sort of state of affairs. Take a look at the next slide very briefly. The apartment sector obviously been sort of a significant focus for a lot of people in the market, and what this slide shows is that vacancy rates, the green line in the top chart, while vacancy rates are certainly up, and this is something that you'll see in data from a number of different firms, it's also the case that by any historic norm, vacancy rates in the apartment sector are extremely low, low enough that we continue to see significant upward pressure on rents, and in most markets, rents growing in excess of the rate at which household incomes are growing, which obviously presents a bit of a challenge. If we jump ahead to the slide on cap rates, what we're going to see there, again, is that while we've had this sort of protracted period of very low cap rates in the market in the United States, I think sort of like many other economists, I've sort of spent a lot of my time sort of making conjectures about when it is that we'll see an inflection in the market and when cap rates will begin to trend back up again, how much the increase in interest rates in the market will be absorbed into the spreads versus the absolute caps that we see out there. I think what this chart shows you very clearly is that overall, cap rates continue, in fact, to decline. Where we do have some increases, they are generally fairly modest. We have increases in the retail sector, which is obviously under a fair degree of scrutiny, not sort of a favored asset class right now. So some selection bias in what's getting traded there. But even in that case, I think what you can see is that the increase in cap rates there has been relatively modest. It's the hotel sector in this chart where we see, some of the more significant increases. But overall, apartment, or I think a lot of the speculation, a lot of the questions have been around, how much more could cap rates actually decline? Cap rates do continue to trend lower. That 5.5% to 6% range, perhaps not being within the scope of recent experience for folks who are based in Manhattan or the waterfront in Brooklyn. But when we look sort of a broad cross-section of the country, look at that $3 million, $5 million transaction, on average, the cap rates there are going to be a little bit higher than what we see in New York or San Francisco or any of the other major metropolitan areas in the United States. Take a look at the last slide in this section then that describes employment growth by state. I think what you're going to see here is that we're in an unusual spot from a macro perspective. The employment numbers are generally strong and fairly consistent across the country. We have some isolated issues. If we were to look at this in terms of the business cycle, however, I think part of what we see reflected in the most recent set of employment data is that in 2017, we've actually been creating on average fewer jobs than was the case a year ago or 2 years ago or 3 years ago. A couple of different ways you can always interpret the employment data. One way would be to say, oh, well, job growth is slowing. And that's a bad thing. Part of what we actually see happening here is that the labor market's gotten very tight. For occupations where labor is in demand, we have skill shortages in some cases. And so there are a very large number of unfilled positions. On an absolute basis, we have more unfilled jobs available in the United States today than really has ever been the case. But it's tough to fill those jobs given scarcity in some aspects of the labor market, and that's contributing in part to why it is that we've got lower rates at which we're creating new jobs on a net basis every month. The piece that's missing here is that we would have expected under these conditions to get much stronger rates of employment, the salary and compensation growth, and we really don't have that yet. Certainly, salary and wage growth has improved over the course of the last couple of years, but it has been highly concentrated in the top tiers of the income distribution. High-skilled labor has sort of taken the bulk of those increases in moderate and low-skilled occupations. Even in some cases where we've had that tightness in the labor market, we have not seen what we would have expected in previous cycles, and certainly our textbook would tell us which would be much more significant upward pressure on wages. If we take a look then in the next section, which focuses a little bit on the multifamily sector in particular, obviously sort of everyone sort of favored asset class over the course of this cycle, but one where I think there are real questions about not only how much further could we go with underwriting, how much more room is there to increase debt levels, to drop debt yields lower, but also from a fundamentals perspective, we've had a lot of inventory come online. That has been something that we've been able to absorb because we've not seen that a lot of households have moved into home ownership. And so the bulk of new household formation rates in the United States have opted into or had to go into, as a result of constraints in being able to obtain mortgage financing, the renter-occupied population. So look at how many millions of renters have we added to the United States over the course of this cycle versus how many new rental units have we added? And it's no surprise when you look at it in those terms that we haven't seen meaningful increases in vacancy rates. Where we have a bigger challenge is not necessarily comparing different metropolitan areas. Obviously, you're going to have isolated metros here or there where there is a significant oversupply issue. You're going to have dynamics around sort of depletion of the rental stock in markets that are impacted by natural disasters. Those are all going to be relatively idiosyncratic. Probably the more systematic thing that we see is that the bulk of new construction has been concentrated in the urban core in Class A, high quality, high amenity, high-rise multifamily. And we've not seen as much come online in relatively more suburban areas or smaller low-amenity properties. When we look at how demographics change over the course of the next decade, probably the area where I'd suggest we'll see the bulk of the impact of oversupply. It'll be a subset of the multifamily market, and that we're going to have an abundance of studios and small one-bedroom apartments. That works now. As millennial households move along, however slowly they may do it in their household's life cycle, eventually a tiny studio apartment isn't going to make a lot of sense for them. And so it's really more about the mix of unit types, locations, as opposed to sort of a raw or absolute oversupply in multifamily markets in the United States. If we're to jump ahead then, and we can see this sort of, again, captured in the slide, fundamentals continue to improve. You can see information on sales volume and prices. What this shows is that, again, in some segments of the market, for some asset classes, retail, hospitality, we've seen declines in activity and some tightening up of underwriting standards. For the market in multifamily, it remains highly liquid, very robust. The fundamentals in general remain, again, sort of exceptionally strong by historic norms. And so while you can see that there is a bit of a drop-off here in sales volume, some of that is going to reflect sort of those very large entity-level transactions. But this is about as soft a landing as we might get in any commercial real estate cycle. And so, while there's certainly sources of risk to multifamily and to the economy at large, at least thus far, the slowdown in overall multifamily activity is something that I would describe by any historic norm as really being quite manageable. Now, with that, we're going to jump into a discussion of the valuation trends, and I will pass it along. Sorry, Susan, did you want to jump in over here?
Yes, hi. So for bridge lending, we typically used for value add scenarios, and they typically require 2 to 3 estimates of value. You need your as-is value to be FIREA compliant. Typically, sometimes you'll have an as-complete value if there are extensive renovations to be done, and then a stabilized value at the point where the property is operating at a stabilized income basis. Renovations can be, just fixing immediate repairs that are needed that might be noted in a property condition report, or items that would increase the curb appeal of the property. Maybe putting in a playground, paving, new roofing, landscaping, things like that. On the interior, things that give you a good bang for your buck would be updating kitchens and bathrooms, some new flooring. Sometimes a renovation is not part of the plan for a value add transaction. There could be poor management in place, inexperienced management. So you can acquire the property at a discount and then improve NOI with proactive management, increasing occupancy, and trimming some expenses. Or there could be some low income rents in place. In this case, the below market rents will vacate over time as the assets convert to market rate, and you increase your NOI and therefore your value that way. What you have to consider when you're looking at a property that is not stabilized or has deferred maintenance or other ways in which to increase value, you have to look at the costs to achieve stabilization. And can you acquire the property at a price that makes sense given the capital outlay that you would have to make to including an amount for profit or risk, which would be reflected in an appraisal to make the deal make sense. It's difficult to determine how to determine the appropriate profit or risk rate. Sometimes it's it can be subjective. It could require the use of a discounted cash flow with maybe a higher internal rate of return versus on an as-is basis. Versus on a stabilized basis, but typically that range is going to be, could be from 25 to 150% of the total CapEx, depending on the amount. Typically, it's going to be at least $100,000 for a small property and anywhere up to $5,000 for a large property. And it really varies by the property and the budgeted capital outlay, and also factors like location and other risk factors that could play a role. Moving on to the challenges is, from a valuation standpoint, would be, if we're going to try to justify an increase in rents post-renovation, then we have to have the data to be able to show that. So that could mean 2 sets of comps, as is and as complete, if there's a renovation involved. So the second set would be newer properties in better condition, things like that. And then substantiating decreased expenses, which you would do with expense comps. And again, you might have to look at different sets of expense comps for the 2 scenarios. One of the big things to keep in mind is that there are many jurisdictions now across the country, Florida for example, where taxes are based on a new assessment when a property is sold. And so what that means is, in an appraisal, the premise of a market value appraisal is that the property is selling. So in that case, the new assessment is going to be based on the new value. In some markets, a sale does not trigger a reassessment, but there are many markets that do. And so you're going to have to, when you pro forma and do your budgets and your analysis, you're going to have to make sure that you project taxes accordingly based on the jurisdictional regulations in any given county. It's by county and not by state. And a lot of times there's a range, but taxes, if are triggered by a sale, can be as high as 90% of the value. And that often is a significant 20, 30, sometimes 40% increase in the real estate tax expense. So that's a big factor to look into. On the next slide, though, you can see that on a methodology basis, you basically value the property hypothetically as renovated, and then you need to deduct the costs, including profit, to get to the as-is value. And the as-is value is going to be compared to the acquisition price. So the goal is for the as-is value to at least be the acquisition price, no less. As far as working through the income approach, the methodology is pretty similar. You look at your historicals, you look at your pro forma, you look at your forecast, which has to be supported by the data, and then you come up with your rates, various factors, get to a value, and then again, you need to subtract off the cost of renovation and profit. In this case, the profit was 75%. It was 75% of the renovation cost. And lease up costs as well, which would be rent loss. It would be any other additional expenses that would be incurred to lease the property up. So there could be additional advertising expenses, et cetera. Going on to the next, there are various things that the appraiser is going to need. So if you're going to get ready to work on a deal like this, you're going to have enough information. The biggest thing is the detailed renovation or your detailed pro forma budget, as is and post-renovation. Additionally, there are various factors that everyone needs for an appraisal, which is operating statements, operating history, a current rent roll, and things like that.
Great.
That's pretty fast, but we'll take questions later.
Great. Thanks, Susan. So I'm just going to run through some of the highlights of a bridge program. So what a bridge loan does for a user is it allows them to get financing on an asset that wouldn't traditionally be able to be financed, or at least not at the levels of a bridge product, given any one of a number of issues that the property may have. Maybe it's lease up, maybe it's a buyout, maybe you're doing renovations, as Susan just mentioned. Maybe you're waiting for some regulatory documentation to burn off the asset. The bridge program fills in the gap between where the property is now and where the stabilized operations of the property are going to be. Traditionally, bridge loans are underwritten, processed, and closed quicker than your typical agency, bank, or CMBS financing. We require probably a little bit more diligence, just given the nature of the product, but it's usually underwritten in a little bit of a quicker time frame. We're non-recourse, and on deals that require it, deals with no cash flow, then we'll take an interest reserve with some kind of replenishment guarantees, so that way the deal is supported while you're going through the business plan. Some of our basic bridge loan terms, they're on the screen here. They're pretty self-explanatory. We have a $5 million minimum. We generally underwrite to an exit loan. So what happens is we'll look at where the property is today, and we'll try to determine what the stabilized value of the asset's going to be. And we like to be in a 75% range of that stabilized value. And obviously the reason for that is because we're underwriting to an exit loan. So we'd like to see an exit loan at a 75% level. Obviously understand that you get financing higher than that, but we need to build in a little cushion for potential rise in rates or change in direction of the agencies or of the markets. All of our deals are floating rate. They float over the 30-day LIBOR. Spreads just vary based on the deal, the business plan, the borrower, and a couple of other key points. We are generally non-recourse with the exception of interest replenishment and performance tests that may be structured into the deal. Obviously, first mortgages. We do a number of different asset classes. We do most of the deals that we do are multifamily deals. Probably, I'm going to say 80% of the deals that we do are multifamily, with the balance being, office, hospitality, retail, some student housing, and industrial. Our appetite for those deals moves around a little bit. So, you might have a deal that we're really excited about. There might be a student housing that we're really excited about today, but 6 months from now, maybe we don't have as much of an appetite for it just because we've done a few other deals. So timing is kind of important on those. Everybody loves prepayment, so prepayment is generally permitted on these deals. Sometimes we'll have some yield maintenance just to catch up, but it's very, very reasonable. And then obviously sponsorship, is probably the most important part of any transaction because you're always lending money to a sponsor. So we'd like to see somebody with the appropriate net worth and liquidity. The pricing, which I know is a pretty important question for everybody on where this stuff lands, and I kind of glossed over it quickly here. But pricing is one of those things that's very difficult to just give a blanket idea. And I could say it's in the high 4s to low 5s over LIBOR. But really, there's a lot that goes into it. It's what market is the asset in, what kind of experience, net worth, liquidity does the borrower have, what's the magnitude of the business plan. Obviously, if you have an asset that you're acquiring and the NOI is $1 million and you just need the NOI to go to a $1.1 million to get taken out on a perm loan, then that's a very reasonable business plan. If you have an asset that you're acquiring that has a $500,000 NOI and you need the NOI to go to $1.5 million, obviously the magnitude of that business plan is much more significant, and that plays into the pricing as well. Just to walk through a couple of very quick case studies, you'll notice the similarities in both of these because, obviously our bridge loans, and we're always lending to the exit. So in this first one, it's very, very traditional, right? It's an acquisition, renovation, and stabilization. So you get a client who's buying a multifamily property. It's only 80% occupied, let's say because 15% of the units were damaged due to fire, let's just say. The problem is that he can't get any kind of significant financing or appropriate financing given that kind of physical vacancy. So he'll come to us. We'll give him a loan that will provide acquisition financing as well as whatever dollars are needed to bring those units back up online and stabilize them. We work hand in hand with the borrower to make sure the renovation program is appropriate. We hold back renovation dollars, so to the extent the borrower spends those monies, we fund the rent. It's very similar to a construction loan. We fund the money to the borrower, and at the end of the day, once we're fully funded, once the property is stabilized, the idea is that they come back to us for the takeout loan, which is going to be either agency or CMBS, HUD, whatever it may be. And we do structure our deals such that it's advantageous for a borrower to come back to us on the exit loans. Usually it's done through an exit fee where our bridge loan will have an exit fee in it that'll be waived if we provide the permanent financing on that asset. The second case study, again, is something that Susan spoke about earlier. We've seen this on occasion where a client is buying a multifamily property, let's say that's currently subject to a land use restriction that says, for example, your tenant base can't be making a salary of more than, let's say, 60% of area median income. As a result, your rents are artificially low because it's meant to be housing for lower income individuals. Those lures can run anywhere from 10 to 25 years, and then there's usually a little bit of a burn-off period on those. So what we have seen is guys buying assets where the lure is burning off, let's say, in the next year. Once the lure burns off, they need, let's say, 2 to 3 years to turn the property around, meaning get those tenants that are currently in there paying the lower rents, roll them out to more traditional market rate tenants, maybe do a little bit of work. And then obviously once they're able to roll everybody out, get those higher rents, the NOI increases, and then you have an exit loan that's viable. In a lot of cases, the exit loan ends up giving the borrower a significant amount of his equity back in the transaction, and the borrowers really love that stuff. So those are some two very basic case studies. Again, you'll notice that they follow the same pattern, right? The asset, for one reason or another, doesn't have the value of the cash flow to accept or qualify for quote-unquote permanent financing. So what we do is we bridge the period from when they can't get that financing to when they can get that financing.
Thanks very much, Johnny. At that point, I think we're going to move it into Q&A, and we do have a fair list of questions here. The first one, both for Susan and Gianni, and it may or may not be an answer related to bridge lending specifically, but what aspect of the real estate market is most concerning to you at this time, and has that changed over the course of the last year? Susan, if you could kick us off.
Yeah, well, there's a couple things. The primary one is low interest rates and low cap rates, and that really hasn't changed in the last year, but it's not at a level that is sustainable. So there's concern really about how long this level of low cap rate environment can be sustained. As far as like property types, retail is the asset class that we're most concerned about. There are a lot of bankruptcies. We've got vacant big box units in retail centers that are being difficult to lease, and they're going to take demising and capital to re-tenant, backfill them. There are just not that many big box or junior anchor tenants out there to backfill these units. So retail is an area of concern as well.
Yeah. So given the degree of variation within the retail sector, the many different types of retail that we've got out there, are there particular segments of the market that are going to have a tougher time over the next couple of years, some that are adapting better to the changes in consumer behaviors and buying patterns?
Well, I mean, I think, malls are having some difficulty as well. The very high-end malls and high-end markets are still doing very well, and the cap rates on those are still low. Sales are strong. Values are holding. But malls are having trouble, too, especially the mid-tier ones, because we're worried about, Kmart and Sears. So there are going to be a lot of big anchor stores vacant. And a lot of them already are. They've been closing. They've been, subletting a lot of them, but that's a factor as well.
Johnny, what aspect of the market are you most concerned about right now?
Well, I mean, generally, we Susan and I are on the same page. I mean, as far as the retail goes, we're very, very bearish on retail. There is some, neighborhood retail that we think is always going to do well. Your grocery anchored kind of strip malls, community strip centers that you're always going to need within that community. So, if we do go into a real estate deal, it's more along those lines. But yeah, I mean, the cap rates getting pushed down are clearly a concern along with interest rates. One of the things that's helping push cap rates down and has been for the last probably few years at this point is foreign investments. You have a lot of foreign money coming in, especially in gateway cities, and really pushing purchase prices up, and as a result, pushing cap rates down. We've also been seeing a lot of, I don't want to say inexperienced buyers, but we're also seeing a lot of buyers that are looking to take the next step. So you have a guy who's probably a mid-level type of a real estate guy, maybe owns a handful of properties, in the Midwest, and looking to take a very, very big leap into his next asset. So where, the last 7 or 8 or a dozen loans that he's done has been, let's say, under $10 million, he's now looking to step up and get into, a $30, $40 million loan. And the dynamics are a little bit different in those loans. The assets are a little bit different in those loans. So we take a really, really strong look at experience of the borrower, and specifically experience of a borrower within a certain market. Of course, if a borrower owns assets in a market that he's buying more assets in, that's good. If you have a guy who's, based out of California with a management company based out of Texas buying a property in Minnesota, you're a little less comfortable with it.
So I'll chime in finally. I think my concern about the market is a little bit different. Certainly, concerns about some of the things that we see happening for individual property types, some concerns around, the sort of, all the interest rate issues, aggressiveness in valuation, both by, investors and lenders. Probably the more immediate concern for me, though, is where we are in the macroeconomic cycle. This expansion is getting a little long in the tooth. It began in mid-year 2009. And while no expansion sort of, dies of old age, I think we are seeing signals of unusual risk-taking behavior in other segments of the market, not necessarily real estate. But when we look at sort of corporate debt levels, for example, and the supportability of that corporate debt as interest rates rise, many companies, I think, are actually in a much tougher position than we find ourselves in the property sector. And at the end of the day, commercial real estate does not move independent of the macroeconomic cycle, at least not for extended periods of time. And so I think we may be under-assessing some of those macro risks that could, in fact, obviate an increase in interest rates. If we have that next inflection before, the Federal Reserve, continues along its path to normalization in interest rates, we may not actually get to their target rate over the course of this cycle. Let me put another one to you that's more specific to bridge loans. And Johnny, if you could start us off on this one. A couple of folks are asking about the availability of bridge financing really to get you to that first step. And so if I'm looking at sort of an opportunity to develop, to purchase, but I need bridge financing to get to that first step, is that something that's available?
Yeah, well, it is available. It all depends on the deal. I mean, from my experience, kind of, let's say, first-time real estate buyers tend to gravitate towards banks, and they tend to get debt from whatever bank they have banking relationships with. A guy might keep all his money at, whatever, Bank of America, and he's going to go to his banking contact to try to get debt on real estate. That's what we've seen historically. You do see every once in a while a borrower coming in with very little experience. The only real support for a deal like that is if there are other principals on the deal with them that could provide that support, right? So, you might be new to real estate, but you have two partners that have been in real estate for 40 years, and they're investing a bunch of money in, and they're putting their names on the line as well. That's one way that kind of, and new participants in the acquisition market end up getting bridge loans.
Yeah. So if I could dig in on that and get even a little bit more specific, what's the availability of bridge financing for purchase while I'm concurrently working on underwriting for permanent HUD financing?
Sure. So we actually have a specific program. It's Bridge to HUD. And that program is specifically meant for timing, meaning, as we may or may not know, the HUD process is probably 9 months, and it could be up to a year and even longer to actually go through that entire process. So, because of the nature of the market and the velocity at which sales take place, and really what you have to commit as a buyer to acquire some of these assets, you got to commit to 60-day closings. We have a program specifically designed to go to HUD. That program is a little bit more leverage because HUD gives you a little bit more leverage. We are going to require a HUD application before we close our bridge loan, so that way we have the exit kind of already off and running. And then obviously the pricing is determined based on market, how aggressive the deal is, and who the borrower is.
So as a next question then, both for you and Susan, what are you seeing in the market really to the point with, how are you pricing bridge loans? How does it look as compared to your more permanent financing? What are your loan-to-cost, loan-to-values look like? Benchmark this for me. What does it look like in terms of what it's going to cost me?
Sure. So a couple things. So as far as loan-to-value and loan-to-cost go, your upper end of the range is probably somewhere around an 80% loan-to-cost deal. And that's 80% of appropriate costs, right? If your costs include, a 2-point acquisition fee for yourself and a 3-point broker fee and 2 other points in, you have to pay a couple of other people, we're going to look at it as a market deal, right? So generally speaking, it's purchase price plus any renovation dollars that you need, and then some reasonable closing costs in there. And on our limit on that's probably about 80%. There are times that we go higher than that, but we generally fall between 75 and 80% of that number. The terms are generally 3 years, 2 years with a 1 year extension. And as far as spread goes, like I said, our spreads are generally mid to high 400 over, and they could go all the way to mid 500 over, depending on what the deal is, where the deal is, the magnitude of the renovation program, the experience of the borrower, and all these other kind of aspects. Like Susan said, if you're buying a deal where you're in a market that resets taxes based on acquisition, but that formula is not 100%. I don't want to say accurate, but that formula is not publicized, meaning they could be anywhere from 60% of the valuation to 90% of the valuation, just depending on who you get for the assessor. That's going to roll into our analysis as well. I mean, if you're looking at at a big savings, let's say on the expense side, because you're putting some utility saving program in place, better lighting, low flush toilets, things of that nature. If there's a real good track record of that and it makes sense, then we could get aggressive on it. If it's just kind of a fill, we're going to cut utilities by 50% because we're going to change the light bulbs. Again, that gets a little bit harder to underwrite to.
So, Susan, actually a follow-up to that. Gianni mentioned sort of cost containment and expense management. What's your take on green building, whether LEED certified or not, passive house, as a value add in decreasing costs, specifically as it relates to the availability of bridge financing?
Well, we do a lot of what we call green up appraisals, and really what we don't see much of a value add. Typically what we get is the minimum required to qualify for the lower financing, and a reduction in NOI hasn't typically affected the value significantly. And on a deal we just worked on, actually, they did enough to get the funding, but it did not really. It affected the value about $400,000 on a $28 million deal. So, and it was going to cost them $200,000. So it's not a tremendous increase. A lot of times it's just the savings in the water bill, and it's usually minimal because then a lot of properties are recovering water through RUB storages, and so while they're saving on the expense, they're also saving on the reimbursement. They're also losing on the reimbursement. They're collecting more, so the NOI doesn't really change.
Got it. So no question for both of you. Sorry, go ahead.
I'm sorry. Go ahead.
Please continue.
I was just going to say they do qualify for the funding for the lower rate, but it's not a big value impact.
So we've talked some about retail and about multifamily. A specific question, and Susan, we could start with you. Are you concerned right now about what we see happening with an uptick in industrial inventory? Not
right now. Not right now. I mean, that's very, very strong. We're not. I know there's a lot of construction going on. Amazon is looking around for another headquarters site or a distribution site, but I'm not seeing any concern in the inventory of industrial space at this point in time.
Yeah.
There's
when I look at something like, when I look at sort of how cities in particular have responded to Amazon's search for that second headquarters, a brilliant strategy on Amazon's part to essentially put it out there for auction and to see who will make the best offer, put together the best package. The thing that concerns me is the potential for significant overinvestment on the part of individual markets attempting to attract someone, sort of a firm like Amazon. Somewhat along the lines of what we may have seen, as East Coast ports were competing for some of that net new traffic that would come from Panama Canal expansion. Johnny, thoughts on the industrial market?
Yeah, I mean, I think the industrial market's going to always be there. We don't do a lot of industrial. We do industrials. The biggest aspect for us of industrial is where it's located. What we have found over the past few years is that a lot of traditional industrial centers are being moved around. A A lot of it because, the areas where these centers were historically are being converted and being turned into residential areas more so than industrial areas. So they're being moved out. There's a lot of incentives out there. Certain states, especially if you're in the Midwest, where it's easy for a company to move from, one state to another state. That becomes a little bit difficult to understand sometimes. But yeah, I mean, we like industrial. You're always going to need it. I think the asset class is fine.
Susan, if we take a step back from that, we started the Q&A with a question from one of the listeners about the asset class that may have been the greatest source of concern for you. As a follow-up to that, we actually have a question from another listener who wants to get a sense, and this is really sort of a more real estate cycle question. Which property type, conversely, is best suited to manage its way through a market correction or through an inflection in the cycle?
Well, typically we market multifamily fares pretty well. People are always going to need a place to live. People now may not be able to buy a home, so they rent instead. And also industrial. Industrial does not typically have huge swings in occupancies and rental rates. It's really more office and retail that are generally affected, and hospitality as well.
Yeah, I agree. I mean, you're right. People always do need a place to live when it comes to residential. It's always the best to have multifamily out there. One of the things that we have been seeing, and specifically in certain markets, it's much more prevalent than in others. And Sam, I'd actually like your thoughts on this. But we've been seeing a lot of supply in certain markets come online. Certain submarkets are. We've seen certain submarkets around the country literally, double and triple in supply over the past 2 or 3 years, and some of it doesn't seem to be slowing down at all. How do you see the macro supply picture looking?
Yeah, I think that sort of, in the multifamily sector, when we are looking at the supply side, the numbers have been fairly well balanced between the new inventory that's coming online and the new the number of new rental households. And that's actually been remarkably balanced, which is why I think we see those vacancy rates remain low. I think there have been some imbalances within metropolitan areas. Of course, there are some specific metros where the pipeline is simply too robust. But I think overall what we see is that the challenge is more intra-metropolitan, and so there are some urban cores where the focus has really been on the narrative around sort of the young millennial who wants to live in downtown, who either because of preference or constraint is not interested in or not able to be a homeowner. Millennials will always be millennials. They're not always going to be 25 years old. And I think that presents a real challenge for us in the market, because when we look at the inventory that we've built over the course of the last 5 or 6 years, I think it's been very responsive to the demand profile of a population that ultimately does age. And while they'll get married later and at lower rates than has been the case historically, from an attitudinal perspective, what most millennials will tell us is that they do intend one day to be homeowners. And so in that sense, they don't look too different from previous generations. We also have to be careful around sort of the other end of that pendulum with seniors. Harvard's Joint Center for Housing Studies did a really strong analysis on where it is that seniors are choosing to live. And while we may think of seniors moving to downtowns, they're looking at it from the perspective of, well, independent of the real estate investment opportunity, where seniors choosing to live, this becomes important for us because as the population ages, we have to think really carefully about how it is that we deliver services to an aging American population. What's really interesting about their analysis is that the move amongst many seniors, the zeitgeist is to age in place. Seniors want to remain in their homes, even before they would go to independent or assisted living. And while we tend to think of technologies like Uber, like Amazon Prime Now, as being things that will have high utilization rates with relatively younger segments of the population, I think what's interesting here is that some of those sharing economy services we're starting to see some increase in utilization amongst older Americans that you wouldn't necessarily think of as being sort of the tech-savvy person. But if the thing that's going to push me into independent living is that I can't now drive to the grocery store, to the doctor, to my friend's house, the easy availability of Uber is something that we see making a difference. A lot of these sharing economy technologies are facilitating and allowing people to remain in their homes longer than would have been the case historically. And sort of imagine the scenario where this may not be the person as a profile that you think of being as an early adopter of the newest app. But when the choice is between learning to use your phone or having to leave your home, what we find is that folks learn how to use their phones. And so that's, I think there's a factor there, but it's mostly intra-metropolitan. I do worry about the urban core. The most recent set of demographic data shows some of this tipping again in favor of the suburbs. Not everyone wants to live downtown indefinitely. So some of those lower amenity, smaller properties that are located closer to good quality schools where we haven't built a lot, I think that's an area that I'm looking at. One more question for both of you. With regard to the way in which we've seen improvements in the availability of financing, it seems like yesterday, but it wasn't yesterday. It was 8 years ago or 7 years ago that we had you couldn't get a loan for anything. But there's a rich set of capital sources out there. In the most recent set of data and surveys from the Federal Reserve, a survey that I do with the Real Estate Lenders Association, I think what we see last year and in this year's survey, across a broad cross-section of lenders, some sense that it's time to start tightening up on lending standards, or things will that we're in a good place right now. Industrial really being the one sector where some lenders have told us there's room here both to grow lending volume, but also to be more accommodating of the market. Where something like retail and hospitality, no surprise, folks have indicated that they're retrenching and tightening up on underwriting standards. Where are we in terms of the availability of financing and the aggressiveness or lack thereof in the underwriting? John, if you could kick us off.
I think there's, yeah, sure. I think there's an ample supply of debt providers out there. I mean, and they range, and the gamut goes from traditional lenders all the way up to these much smaller fund shops where you have 2 or 3 guys that are in control of a couple $100 million that they were able to raise, and they're doing probably because they have to make their yield. They're doing higher leveraged, higher cost deals. I've been seeing a lot of deals come in where 2 years ago a deal would come in and there was a request for, let's say, 75%, and there was a requested spread on it. Now these deals are coming in and there's no longer a request. It's coming in with quotes from multiple shops saying this is where everyone else is landing. We need you to be more aggressive in order to win the business. So we are seeing that. So I don't think there's a shortfall of available debt out there. As far as pulling back and underwriting standards, we've been pretty consistent across the board. I mean, we generally, and we have been underwriting to rate rise for our exit loans. We haven't been really compressing cap rates. One of the things that we look at if the situation ever presents itself, and it does every once in a while, is your value creation of the deal. You might have a guy that bought a deal 2 years ago and is now saying, well, it's worth 50% more. If that 50% increase in value is a result of true NOI growth, then that's a great story. If, of that 50%, 90% of it is a result of using a cap rate that's 50 basis points lower than when he bought it, that's just a case of a rising tide, rising all ships, right? So we give a lot less credence to that type of value creation. But I don't get the sense that there's a shortfall of capital out there in the market today.
No, I agree. There's plenty of capital. Yeah, there's plenty of capital out there right now. I've seeing on the appraisal end some loosening of underwriting standards over the past year, which is typical of cycles as they go. On the other hand, there is a lot of scrutiny on making sure that the assumptions that are used in the valuations are supportable. But given a range, there's often some pressure, primarily on the CMBS side, to be as aggressive as possible.
Thank you. Well, we're just about out of time. Gianni Ottaviano at Arbor, Susan Kaminsky at BBG. I want to thank both of you for joining us and the Commercial Observer for hosting. There are a couple of questions that we didn't get to, depending on whether that was for Susan or Gianni. Someone will get back to you with a response to that. Thanks to everyone for joining us today, and I'll pass it back to the Observer team.
Thanks, Ann.
That concludes our webinar for the day. I'd like to thank our panelists and our presenting sponsor, Arbor Realty Trust, for organizing such a compelling discussion. Now remember, you can download today's slides from the resource widget. An on-demand version of this webinar will be available tomorrow and can be accessed through using the same link you received in your registration confirmation. Thanks, everyone, and have a great day.
Thank you.
Thank you.